Investors are sometimes their own worst enemies. When prices are generally rising, for example, greed leads investors to speculate, to make substantial high-risk bets based on optimistic predictions, and to focus on return while ignoring risk. At the other end of the emotional spectrum, when prices are generally falling, fear of losses causes investors to focus solely on the possibility of continued price declines to the exclusion of investment fundamentals. Regardless of the market environment, many investors seek a formula for success. The unfortunate reality is that investment success cannot be captured in a mathematical equation or a computer program. The first section of this book, chapters 1 through 4, examines some of the places where investors stumble. Chapter 1 explores the differences between investing and speculation and between successful and unsuccessful investors, examining in particular the role of market price in investor behavior. Chapter 2 looks at the way Wall Street, with its short-term orientation, conflicts of interest, and upwards bias, maximizes its own best interests, which are not necessarily also those of investors. Chapter 3 examines the behavior of institutional investors who have come to dominate today's financial markets. Chapter 4 uses the case study of junk bonds to illustrate many of the pitfalls highlighted in the first 3 chapters. The rapid growth of the market for newly issued junk bonds was only made possible by the complicity of investors who suspended disbelief. Junk bond buyers greedily accepted promises of a free lunch and willingly adopted new and unproven methods of analysis. Neither Wall Street nor the institutional investment community objected vocally to the widespread proliferation of these flawed instruments. Investors must recognize that the junk bond mania was not a once-in-a-millennium madness, but instead part of the historical ebb and flow of investor sentiment between greed and fear. The important point is not merely that junk bonds were flawed, although they certainly were, but that investors must learn from this very avoidable debacle to escape the next interesting market fad that will inevitably come along. The second important reason to examine the behavior of other investors and speculators is that their actions often inadvertently result in the creation of opportunities for value investors. Institutional investors, for example, frequently act as lumbering behemoths, sampling some securities to large discounts from underlying value even as they ignore or constrain themselves from buying others. Those they decide to purchase, they buy with gusto. Many of these favorites become significantly overvalued, creating selling and perhaps short-selling opportunities. Herds of individual investors acting in tandem can similarly bid up the prices of some securities to crazy levels, even as others are ignored or unceremoniously dumped. Abetted by Wall Street brokers and investment bankers, many individuals as well as institutional investors either ignore or deliberately disregard underlying business value, instead regarding stocks solely as pieces of paper to be traded back and forth. The disregard for investment fundamentals sometimes affects the entire stock market. Consider, for example, the enormous surge in share prices between January and August of 1987, and the ensuing market crash in October that year. In the words of William Ruan and Richard Cunniff, chairman and president of the Sequoia Fund, Inc., disregarding for the moment whether the prevailing level of stock prices on January 1st, 1987 was logical, we are certain that the value of American industry in the aggregate had not increased by 44% as of August 25th. Similarly, it is highly unlikely that the value of American industry declined by 23% on a single day, October 19th. Ultimately, investors must choose sides. One side, the wrong choice, is a seemingly effortless path that offers the comfort of consensus. This course offers succumbing to the forces that guide most market participants, emotional responses dictated by greed and fear, and a short-term orientation emanating from the relative performance derby. Investors following this road increasingly think of stocks like sow bellies as commodities to be bought and sold. This ultimately requires investors to spend their time guessing what the other market participants may do and then trying to do it first. The problem is that exciting possibility of high near-term returns from playing the stock as pieces of paper that you trade game blinds investors to its foolishness. The correct choice for investors is obvious, but requires a level of commitment most are unwilling to make. This choice is known as fundamental analysis, whereby stocks are regarded as fractional ownership of the underlying business that they represent. One form of fundamental analysis, and the strategy that I recommend, is an investment approach known as value investing. There is nothing esoteric about value investing. It is simply the process of determining the value underlying a security and then buying it at a considerable discount from that value. It is really that simple. The greatest challenge is maintaining the requisite patience and discipline to buy only when prices are attractive and to sell when they are not, avoiding the short-term performance frenzy that engulfs most market participants. The focus of most investors differ from that of value investors. Most investors are primarily oriented towards return, how much they can make, and pay little attention to risk, how much they can lose. Institutional investors in particular are usually elevated and therefore measure themselves on the basis of relative performance compared to the market as a whole, to a relative market sector, or to their peers. Value investors, by contrast, have as a primary goal the preservation of their capital. It follows that value investors seek a margin of safety, allowing room for imprecision, bad luck, or analytical error in order to avoid sizable losses over time. A margin of safety is necessary because valuation is an imprecise act. Art. The future is unpredictable and investors are human and do make mistakes. It is adherence to the concept of a margin of safety that best distinguishes value investors from all others who are not as concerned about loss. If investors could predict the future direction of the market, they would certainly not choose to be value investors all the time. Indeed, when securities prices are steadily increasing, a value approach is usually a handicap. Out-of-favor securities lead to rise less than the public's favorites. When the market becomes fully valued on its way to being overvalued, value investors again fare poorly because they sell too soon. The most beneficial time to be a value investor is when the market is falling. This is when downside risk matters and when investors who worried only about what could go right suffer the consequences of undue optimism. Value investors invest with a margin of safety that protects them from those large losses in declining markets. Those who can predict the future should participate fully, indeed on margin using borrowed money, when the market is about to rise and get out of the market before it declines. Unfortunately, many more investors claim the ability to foresee the market's direction than actually possesses that ability. I myself have not met a single one. Those of us who know that we cannot accurately forecast security prices are well advised to consider value investing, a safe and successful strategy for all investment environments. The second section of this book, chapters 5 through 8, explores the philosophy and substance of value investing. Chapter 5 examines why most investors are risk-averse and discusses the investment implications of this attitude. Chapter 6 describes the philosophy of value investing and the meaning of importance of a margin of safety. Chapter 7 considers 3 important underpinnings to value: a bottom-up approach to investment selection, an absolute performance orientation, and analytical emphasis on risk as well as return. Chapter 8 demonstrates the principal methods of securities valuation used by value investors. The third section of this book, chapters 9 through 14, describe the value investment process, the implementation of a value investment philosophy. Chapter 9 explores the research and analytical process where value investors get their ideas and how they evaluate them. Chapter 10 illustrates a number of different value investment opportunities ranging from corporate liquidations to spin-offs and risk arbitrage. Chapters 11 and 12 examine 2 specialized value investment niches: thrift conversions and financially distressed and bankrupt securities, respectively. Chapter 13 highlights the importance of a good portfolio management and trading strategies. Finally, Chapter 14 provides some insight into the possible selection of an investment professional to manage your money. The value discipline seems simple enough, but is apparently a difficult one for most investors to grasp or adhere to. As Buffett has often observed, Value investing is not a concept that can be learned and applied gradually over time. It is either absorbed and adopted at once or is never truly learned. I was fortunate to learn value investing at the inception of my investment career from two of its most successful practitioners, Michael Price and the late Max L. Hein of Mutual Shares Corporation. While I had been fascinated by the stock market since childhood and frequently dabbled in the market as a teenager with modest success, working with Max and Mike was like being let in on an incredibly valuable secret. How naive of all my previous investing suddenly seemed compared with the simple but incontrovertible logic of value investing. Indeed, once you adopt a value investment strategy, any other investment behavior starts to seem like gambling. Throughout this book, I criticize certain aspects of the investment business as currently practiced. Many of these criticisms of the industry appear as generalizations and refer more to the pressures brought about by the structure of the investment business than the failings of the individuals within it. I also give numerous examples of scientific investments throughout this book. Many of them were made over the past 9 years by my firm for the benefit of our clients and indeed proved quite profitable. The fact that we made money on them is not the point, however. My goal in including them is to demonstrate the variety of value investment opportunities that have arisen and become known to me during the past decade. An equally long and rich list of examples failed to make it into the final manuscript. I find value investing to be a stimulating, intellectually challenging, ever-changing, and financially rewarding discipline. I hope you invest the time to understand why I find it so in the pages that follow.